Anyway, so on number one on that summer 2013 quiz, okay, we've got periodic FIFO, periodic LIFO, periodic weighted average, perpetual FIFO, perpetual LIFO, perpetual moving average. So we need to know what periodic is. So I'm going to expect you to calculate all 6 of them. We need to know what periodic means. We need to know what perpetual means. And we need to know what FIFO. I guess I should do it this way. For all of these, we need FIFO, LIFO, and average. And what we're going to do is we're going to have weighted average for periodic and moving average for perpetual. And it'll make sense why they're what they are, why they're called that when we go through it. Okay, so what are we talking about here? These are different methods of keeping track of the inventory. That's all it is, okay? So if I'm doing periodic inventory, it means what? I periodically count it and price it out, cost it out, right? What did it cost me? So I periodically count. Small company once a year, bigger companies more often probably, right? Okay, and a really big company, it might, like Walmart takes inventory every day. You know, people taking inventory or companies come in and take inventory, and every day they're counting, and then they have to roll their inventory forward to the end of the year, which is a real pain. But they've got so much inventory, they don't want to count it all one day. Imagine, right? They're not going to shut their stores and have to count inventory. Okay, so anyway, so there's counting going on all the time in companies, but the idea is periodic is what? Periodically, every once in a while. And you do not know how much inventory you have on a continuing basis, unless you count it. That's it, okay? What's perpetual? You perpetually keep track of how much you have. That's it. Every time something comes in, what do? After the inventory. Every time something goes out, what do? Take it out of the inventory. And the journal entries are going to actually reflect that, okay? So that's the big difference there, okay? So let's try what the journal entries would look like for periodic versus perpetual. Give that a shot, okay? And in either case, what we are going to try to do, and with FIFO, LIFO, and average too, what we're going to try to do with any of these, basically 6 methods, right? Okay? With any of these methods, what we're going to try to do is we are going to try to determine cost of goods sold to put on the, where's cost of goods sold? Go, which statement? Income statement. It's the major expense in the income statement. The bookstore, what do you think the major expense is of selling you your book? The book. They had to buy it and give it to you, right? It's by far their biggest expense. They're very expensive, right? Unfortunately, we still use books instead of it all being electronic. It's really silly. What do you pay for that book? $200 bucks? Got it online, used. Okay, yeah, good for you. Okay, as long as you got the same one. Okay, right? She did, right? But it's a couple $100 bucks, isn't it? New one? Try not to buy those, don't we? You didn't buy them anyway, your parents did.
Amazon.
Leeches. Amazon, okay, yeah. My kids did the same thing. I don't care what it costs, you're buying it. Okay, anyway, right? Yeah. Real nice, real nice. Wait until your children do that to you. Yeah, they will too. That's why I love my grandchildren. My kids are, yeah. So anyway, the biggest cost they've got of that thing, right, is buying the book themselves, sell to you, right? Okay. Anyway, it should all be electronic, and they should be selling to you for $50. Really should. It's silly. What do they do with the electronic now? You have to buy the real one, buy it electronic. What? Yeah. Anyway, so we want cost of goods sold in that. This is the big expense item. What it's going to be is your beginning inventory, of course, plus your purchases. And guess what we're going to call that? Because we're so clever. Beginning inventory plus purchases is what? How much you have available. Okay? What I start with plus what I buy is what I have. Oh, wow. This is hard.
Okay. Everything you have, what'd you say it was?
Beginning inventory plus purchases. I can't read my writing terribly. Okay, anyway, beginning inventory plus purchases. I usually leave the R out, so I wrote it in there that time. I actually have students write purchases on their quizzes. What's a purchase? But anyway, okay. It's purchase, okay, beginning inventory plus purchases is available, less what? Ending inventory. Okay, what I start with plus what I buy is what I have. If I take away what's left at the end, it's what I don't have, and what do I call that? Cost of goods sold. Ta-da. It might also be cost of goods stolen. and lost, destroyed, damaged, going away. In periodic it will be, because we don't know whether it's period, periodic, and perpetual. We will. We'll know it's supposed to be there. In periodic, we don't know. Okay? You got the idea here, guys? So far, what we've been doing, believe it or not, is perpetual. Let's do the journal entries for periodic and perpetual. So far, we've been doing perpetual. That says perpetual. I have to do that. Okay? All right? So far, we've been doing that. What did we do when we bought inventory? Buy the inventory. What would you do? What would be the entry for buying inventory? Debit. Inventory. So merchandise inventory. Debited. And what would we credit?
Accounts payable.
Typically accounts payable, because typically it's on account between businesses, right? Probably buying your inventory from the business, not from consumers. That'd be weird. Okay? So, but it might also be what? Cash. Right? Okay? So sure. And then how do you pay the payable? What do you guys pay your payables with? Cash. So you would do what? Debit accounts payable and credit cash. So stuff you already know, right? We're just layering another little piece on. Okay? You remember at the beginning of the class that I told you guys that if you didn't really go after it for the first 4 chapters, that you were pretty much screwed? Imagine if you didn't know that you credit cash, debit accounts payable to pay a payable at this point. If you're still learning that. It's kind of over, and get the idea? So keep layering the new piece on. Keep yourself going, right? You get to have a break when? Christmas. It's a long one. 3 weeks or something? I love my job. I get the same weeks off now that I'm not a chair. It's wonderful. I don't have to do anything. I'm going to take off. My wife and I are going to Destin for a week over Christmas. And before we go, we're going to play with our grandkids for a week, right? Christmas Day with them. Then we're going to go to Destin and play for a week. It's wonderful. Okay, you're not going to get that early in your careers. Later you will, though, if you work really hard. When you're too old to enjoy it like me. I still enjoy it, so not that bad yet. Okay, so anyway, that's when you get a break. You know, you'll still be working at your part-time job, but maybe it'll be full-time over the break, but at least you won't be in school, right? Then you come back and you work again for 16 weeks. That's what I want for you guys. That's what I want you to do, okay? And you'll be successful people. When you're not on vacation, what should you be doing? Working. Do it. Be good for your career, right? Keep that in mind. Okay. Yeah.
All right, well, we were talking about in the other class, we had like merchandise inventory and then accounts payable, then we said accounts receivable. Is that for the, like,
That's
the
the sale.
That's
We'll
for
get
the company.
This is the purchase. This is a purchase. Okay? Right?
So there's
The
two different
sale,
things.
there's 2 different things. Sale is they give up the inventory. Purchase is they get the inventory. Make sense? Okay, let's do periodic though. What happens if done periodic? Instead of using inventory, I don't keep track of the inventory, right? What do? I debit an account named what? You guys read it in the chapter. What is it? Purchase. He doesn't remember from the chapter. He came to the last class. Okay, so debit purchases and credit what? He wants to be smarter than everybody else. Rotten, working harder than other people. Bad thing. Okay, anyway, it's not fair, right? Sort of like when you do sports, people who practice longer than you. It's not fair, right? More prepared? Nah. Okay, anyway, debit purchases and credit accounts payable. Then when we pay it, what do? Debit accounts payable, credit cash. Big deal. Okay, let's do a sale. You guys can do these. You see the difference between them? That versus that? That's it. Okay? By the way, here's purchases. Right? Here's inventory. Everybody agree? Okay. All right. By the way, cost of goods sold is going to be the same with either of these methods. Okay? Just how we keep track of it as we go. All right. What are we going to do when we sell something? For the sales price, what are you going to do? Debit what and credit what? With both of them, what will it be? Sell something. Sell product.
Debit, accounts receivable.
I think so. Don't you guys debit accounts receivable when you sell things? Unless you sold it for cash, then what would you do? Debit cash. Unless they paid you in advance, what would you do when you sell it? Debit unearned revenue, right, guys? You could have it with the advance or deposit, right? Yeah, unearned revenue. Okay. And credit what? Sales. What is it with us human beings? If I'm going to sit in a group and I know I don't have to say anything, I can just go to sleep and not worry about it. True? why lecturing doesn't work. That's why I don't rely on lecturing. I rely on torturing you guys with quizzes and tests to get you to learn, right? Because what do you have a tendency to do when you come in here? God, I could just make it to 150, and I'm free. Don't do it to yourself, right? How many hours do we get together, you guys? Oh, 40 or so? And then maybe, I don't know, 20, 25 hours of review sessions if you make it to all. To learn everything that's in that book over the cover. So I'm going to explain it all to you in 40 hours in class, plus another 20, 25 review sessions. Everything I'm going to have explained to you, right? I mean, impart all the knowledge that I have and all the knowledge that's in there in that period of time. That, of course, is not going to happen. But I'm going to expect you to know it, right? So the little bit of time that we spend together, what do you really need to do? And you guys aren't as bad as the other group today, right? They were really something. But what's the deal? You got to get your head into it. You got to stay with it. You got to go after it, right? You don't have to answer the questions out loud, but I can tell that you're not answering them in your head either by looking at you. I've been doing this a long time. I can look at you. They didn't hear what I said in the last thing. Didn't formulate an answer. Nothing's happening, right? Okay. Don't tell yourself I already know how to do that, so I don't need to repeat it. That's a big mistake. Sports again. Can the coach show you how to do something, and then you immediately know how to do it in a game, right? Boom. Doesn't work out. It just doesn't work. All right. What do you think the journal entry is in perpetual? That says perpetual on us. Okay. What do you think? Accounts receivable, or cash, or unearned revenue, and sales. It's exactly the same. That's for the sale. Okay, now here's where things get different.
Now what's that one right down in the middle? Like,
accounts receivable and sales. They're exact same.
are you just showing two different ways of doing it?
Yeah, this is periodic. This is perpetual.
I mean, like, there's like LIFO and FIFO. Is that like?
Oh no, we're not doing that yet.
Okay.
And the journal entry, but that's a good question though. The journal entries for LIFO and FIFO and average don't change. They're the same entries.
Okay.
That only periodic perpetual make that be a different thing.
So there's just two examples for a periodic and.
Okay. Yes, you got it. Okay. If you were using periodic or if you were using perpetual.
Okay.
Okay, good.
All
right. So the difference is you debit purchases for periodic, you debit merchandise inventory for perpetual, huh? Because I'm perpetually keeping track of how much I have to debit inventory. Make sense? Because I'm not keeping track of it, I debit purchases. Make sense? Okay. Now what do we do? That's the sale price. What do we do with the cost of what we sold? Here, nothing. We do not record anything for cost of goods sold. All right? So this was a sale. What are we going to do with the cost of the sale? We don't do anything if we are using periodic. We periodically compute it instead. Okay, what are we going to do though for perpetual? I'm going to keep track of how much inventory I have. If I send inventory out with my customer, it's gone. What do I do to inventory? What have we been doing all along to inventory? You don't have it anymore, it's an asset. What do you want to do to it? Reduce it with a credit. And what do you debit, of course? What is that? Major cost of getting my sale is called cost of goods sold. So the big difference, that's a G. The big difference is I record my cost of goods sold, right, under perpetual, and I do not under periodic. But then here's what happens. Under periodic, I'm going to show the beginning inventory. It'll be the same as if it was perpetual, because guess what? I count anyway, right? If I have to count to find out how much I have, because my inventory records probably don't really reflect how much I have, even if it's perpetual. Why not? Have you ever gone to a store and tried to buy something, and they think they have it when they check in the computer, but they do not have it when they go to the shelf or they go to the rack if it's a clothing store? Happens a lot, huh? And then they look on the rack and say, oh, we don't have it, but I'm sure there's one in another store across town. You, of course, drive across town to get that item at the other store without calling them first, right? Of course not. Why do you call them? Because you know their inventory records can be screwed up. How can they get screwed up? You buy something and you fail to debit inventory. You sell something and you fail to credit inventory. Somebody steals it. So, of course, you're not crediting inventory, right? Have you ever seen anybody steal a six-pack of beer and run out of a convenience store with the beer, and on the way out they stop by the check stand and say, be sure and update your inventory records, I'm stealing this? Doesn't happen, right? How about if a forklift driver drives over some product out of a loading dock? Will they always tell their boss that they ran over it so they update the inventory record? Or will they sometimes pick it up and throw it in the dumpster and try to get away with it? Yeah. Good managers, that never happens. Because their employees know they're not going to get fired for making a mistake. Poor managers, that happens. They don't know how much inventory they have. Because their employees are all terrified they're going to get fired. Anybody ever worked in an environment where everybody's terrified they're going to get fired? They get no work done. Because they're just worried all the time. I try to balance this. I'm trying to scare the hell out of you so you'll work, but I don't want to demoralize you. Right? Okay, I don't really want to scare the hell out of you. I just want you to know what you got to do. Right? I want you to work. That's all. So if you were working for me, would I have high expectations? I'd say, I really want to pay you a whole bunch of money. You gotta learn how to do this and do it fast. Because I want to pay you a whole bunch of money. And also, we want to get it done. Right? So you can go home. Right? Not because you want to be a slave driver. Right? I want you to be your own slave driver. Right? I mean, hell, I can't even get myself motivated. I got to get you motivated. Okay, anyway. All right, guys. So you got the idea? For periodic, we'll have that beginning. We'll add our purchases that are in the purchases account. We'll know it's available. We'll go count the inventory. We'll adjust our inventory, right? From what's on the books to what it really is. Right? Got the idea? But what's on the books is last year. If you're only taking the inventory once a year. Got the idea? So whenever I take the inventory, I adjust. Everybody got it? So then I know what's available. So I add up the beginning inventory plus the purchases. I subtract my ending inventory, and what do I have? Cost of goods sold. Do I know how much was stolen or damaged, lost, whatever, under periodic? No. Weaker internal control then, control of your business, right? Call it internal control. Weaker control of your business under periodic and perpetual. But it tends to be cheaper. Why? You don't have to keep track of everything that came in, everything that went out, and when it happened. But with computers, what's the deal?
Don't spend the money on computers, you can do periodic.
Yeah, if you periodic, you don't have to buy the computers. That's right. So if you're a little tiny company, might you be periodic? Yes. Right? What if you're a real big company? You can go perpetual. Absolutely. For any size whatsoever. Because it's getting cheaper and cheaper to get computers. What happens? Right? You were talking about the lumber yard you worked for. Something, I can't remember their name. 84 Lumber. It's 84. Probably was Highway 84 or something. Who knows? 84 Lumber. Right? When I started.
That was jobs where, like when you talk about like forklifts running over, you need to tell that because my dad also works for, my dad works on construction, and whenever he always had problems with them because they always say they have it when they actually did it.
They don't. Yeah. And that hurts their business, and it really helps Home Depot and Lowe's because they try not to do that. They have better systems. If you were to take over that company, could you help them? Yes. That's the future, you guys.
A lot better. Their wood is.
Their wood's better, yeah. So they have better product.
And then they also sell.
But not as good as service. Maybe.
They also sell at lower prices too.
So what's the deal? What happens there when somebody brings in a truck, right, loaded with stuff? It's all on pallets. Pallets are all shrink wrapped nowadays, right? Shrink wrap around. Very big stuff, all shrink wrapped. On top of that, either in the shrink wrap itself or just a piece of paper underneath it, right, is a barcode. What does that barcode do? It goes under a scanner up in the ceiling, right? You drive the truck in, right? Or at least load the pallets in one at a time, however you want to do it, right? It goes under that scanner. What's happening? Scanner reads what's on that pallet and does what? Debit inventory and credit accounts payable. Update all the inventory records for all those inventory items. Then what happens with it? Everything that leaves the place, Walmart, everything that leaves the place, what happens? It gets scanned. What's it doing? It's recording the sale. It's recording the cost of goods sold. It's debit, cost of goods sold, and credit inventory. Right? It's automatically keeping track of everything. People used to have to do that by hand if they wanted to be perpetual. Right? You got the idea? So it's easy now with computers. So far more companies now are perpetual than are periodic. But how about if you're growing corn and you have ears of corn out in a big pile in the field, right? Actually store it that way, right? Put a tarp over the top of it. No kidding. Or it's in a silo, and you load it up in the silo, right? You're going to have to estimate how much you have. Count and estimate, right? You don't actually count all the ears of corn. Okay? But you're going to estimate how much corn you've got, right? It's not a barcode on each ear of corn. Got the idea? So it depends what your inventory is. So there's still lots of people, periodic, lots of people, professional. Got the idea here? You know what's really fun is you actually estimate the inventory. When I was out on the West Coast, people would be growing it. Lots of apples are grown in Eastern Washington, where I was working, Central Washington University. You'd have to estimate how many apples were on the tree and how much they weighed and what their quality was to value their inventory of apples that are on the trees. So this gets really hard, right? Really complex and fun. One time we estimated how many cattle there was a feedlot raising cattle and the cattle business, and they're all crammed together, you know, on acre after acre after acre. We had to estimate how many pounds of beef were out there. Yeah, it was really cool. We had a helicopter to fly over and take pictures of the thing. And then we laid it all out on a conference room floor and put all the pictures together. And we counted sections of it on a test basis to figure out about how many steers were in each place, right? And then we got average weights on them, and we did all kinds of stuff and came up with an estimate of how much beef was out there. Because we didn't want to count each one of them. At first, they thought we needed to test counting. How do you test counting? And by the way, they're really strange animals. They all like to gather together in one place. And then there's some that have different personalities and they're all by themselves. So it's not the same density everywhere, right? And it's really fun. It's really interesting. So all kinds of things you get to do with this. So this is the tip of the iceberg, right? Tip of the iceberg here in terms of what we're trying to do. So all of it, though, is about figuring out how much is ending inventory and how much is cost of goods sold. Got the idea? So you see how these things work? Right? These two different systems? By the way, this section of the income statement is going to look exactly the same periodic or perpetual. Exactly the same. And exactly the same FIFO, LIFO, or average. Got the idea? Everybody good? Good so far. Okay. So let's add FIFO, LIFO, and average to it. What does FIFO mean? First in, first out. That's all it means. What does LIFO mean? Last in, first out. Okay, so this is the big thing that hangs everybody up. If under FIFO you sell the first stuff, which would be what? The beginning inventory gets sold first, and then the first purchase, and the second purchase, and the third, so on. And in a real company, of course, there might be thousands of purchases or hundreds of purchases. But anyhow, you buy at least probably 12 of one a month, you know, a little company, right? Okay, so there are a number of purchases. So what you do with FIFO, which ones are you selling? The beginning inventory and then the first purchases. So then which ones do you have in ending inventory? The last ones. Remember that. It's the last ones under FIFO. Under LIFO, what's happening there? The opposite. So what we're selling is the most recent purchase and we're keeping the old stuff. Does anybody do that? Really? Lots of people use LIFO for their financial statement purposes. But does anybody really? Imagine a dairy. They've been in business for 100 years. They're always selling the fresh milk and keeping the old milk. What do they have? Quarts of milk sitting there, half gallons of milk that are 100 years old? You want to buy that? You know, if they have to deplete their inventory, they're going to close the business down, they're going to sell everything. Who's going to buy that milk? Nobody? So they don't do that. Does a bakery do it? No. How about an auto manufacturer? They like to keep the old stuff and sell the new. No, they don't. They give you a good deal on the old stuff to get rid of it, don't they? So why is there such a thing as LIFO? LIFO is what? Last in, first out. I sold the most recent ones, and which ones did I keep? My beginning inventory and the first purchase and the second purchase. Really? Nobody does that. Oh, it's for tax purposes. Absolutely. It's for tax purposes.
So when you do LIFO, you save more on taxes, right?
If costs are going up, if your prices are going up, you save more on taxes. Because what's happening? Under LIFO, what ends up in cost of goods sold and what ends up in inventory? LIFO, the old ones end up in inventory. If costs are increasing, your inventory is less. Does that make sense? FIFO, it's the more recent ones are in inventory, right? You have higher inventory. What is your cost of goods sold then? Seeing as everything we've got, it looks just like this. Everything we've got, beginning inventory plus purchases available. If available is the same no matter what, if you make ending inventory more, what you do to cost of goods sold? You make it less. Got the idea? What does LIFO do? It gives you more ending inventory, doesn't it, if costs are going up? Reverse it, costs go down, which is one of the problems with LIFO. That can happen to you. And when does that happen, by the way? When do your inventory costs start going down? It costs you less to buy product now than it used to. Demand for your product is going down. Maybe it's becoming obsolete, right? So as the cost is going down, if there's deflation, what's probably happening to your profitability if your products aren't as popular? It's probably going down too, because your sales prices are going down with it, aren't they? So the cost to replace is going down, but your sales price is probably going down more, and you're starting to liquidate your inventory, which means sell off your inventory. What's going to happen to you? You're going to have really low cost of goods sold because you were using LIFO before, which is going to make you look like you're very profitable even though you're losing money. In your tax return, you look profitable. And you'll have to pay a whole bunch of taxes when you're losing money. I've had clients that were going into bankruptcy because things are falling apart and had a big tax bill. What should you do if you use LIFO? Which I would recommend to all my clients to use LIFO. I'll explain why in just a second. You should use LIFO for tax purposes. Absolutely. Last in, first out. Not very much inventory at all. What does it do for you? The costs are going up. You have what? More inventory, right? I'm sorry, less inventory, more cost of goods sold, and therefore what? Less net income, less taxes. Got the idea? Okay, so you save tax dollars, but should you save the tax savings in some fashion? Have it invested someplace, right? If you have a business downturn, you're going to have to pay those taxes. It's not that you never pay the taxes, you put it off until later. But later might be 100 years from now, if you never deplete your inventory. Got the idea? Interest-free borrowing from the federal government. Who would not take interest-free borrowing from the federal government? Everybody should, if they give it to you. Now, here's the deal. Congress did this on purpose, right? They wrote a law. It's one of those, you hear about tax loopholes like they're horrible things. Most tax loopholes were intentionally placed there, right? They're opportunities for people not to pay taxes. And usually Congress has, when they write the tax law, they have some intention that they're trying to get more jobs or more trade in one area or another. They're trying to do something, right? And generally positive. And we could be cynical and we could say, yeah, they're also trying to help other friends, right? Give them lower tax bills. So if you hold inventory, you can actually save money on your taxes by using LIFO. But here's where they screwed up. But what they did was they said, if you use LIFO for tax return purposes, which will save you a lot of tax dollars now and you pay it later, interest-free borrowing, time value of money, right? Okay? If you use LIFO for tax purposes, you must for financial statement purposes. So we're forced to use LIFO for financial statement purposes. Here's where law tells us in accounting what we have to do, right? The whole rest of the world does not allow LIFO. Under international financial reporting standards, over 100 countries around the world use those. We're the only major economy that does not. We use our own U.S. GAAP. There is one other major economy that doesn't use international financial reporting standards. It's China. Communist, right? They do it their way too. But you know what? They really use international financial reporting standards, and we're starting to a lot too. What we have is a convergence project going on where we're trying to converge U.S. GAAP to international financial reporting standards so they're the same, and then we don't have to adopt it. Why do you suppose our Congress would not want to adopt international financial reporting standards? Because they started in Europe, France. Are we going to let the French tell us how to do accounting? Actually, I'd be happy to let the international financial reporting standards be done in the U.S. It'd be great. But is our Congress going to let France tell us to change our tax code? No. They wouldn't even have to change the tax code. All they'd have to do is allow you to use FIFO for financial statement purposes and LIFO for tax purposes. And then we have something called deferred taxes that we'll learn about later. Okay? So we could do it that way too. By the way, this is billions and billions of dollars in taxes that are paid later instead of currently. Do you suppose the White House would like to get rid of LIFO? Oh, absolutely. They're all gung-ho. Republicans and Democrats, whoever's in the White House is really big on this. What about Congress? Congress has a little different pressures on it, right? Businesses go berserk when you suggest getting rid of LIFO. Why? To disrupt the economy, they say. Well, it would. They'd have to pay all the taxes, right? Although, no, this would be a way that we could raise taxes on corporations without changing tax rates. And then Congress could claim they didn't raise taxes even though they did. So like the bridges, guys, the bridges are not taxes, right? Those fees you're going to pay to cross the bridges, the new bridges, you're going to pay tolls. Those aren't taxes, they're tolls. So they can say, well, no new taxes, right? Of course, you pay more. Be a couple $100 a year for people going back and forth every day, right? That's no new taxes. Remember, you're not paying taxes, right? It's just a fee. Like when you go to national parks and you pay far more than they used to be free, now you pay 20, 25 bucks to get in for your family. It's not a tax, that's a fee. No new taxes, right? They took no new tax places. So I guess what we can't have is no income tax, right? We can have every other kind of fee possible. So anyway, so this would be a way that they could get around it, but I don't think they're going. Okay? So this is a big hang-up of us adopting international financial reporting standards because the rest of the world says you guys are crazy. There's no such thing as LIFO. And you know what? There's not. Only for tax purposes, but they're required, right, for financial statement purposes. So that's where all this comes from. So we have to account for this mess, right? Okay? But look, how many companies do you suppose use LIFO? Anybody of any size who has inventory. If you have inventory, you get this tax break. By the way, what if you're in a service business and you have no inventory? Do you like this tax break for people who have inventories? Not real well, because you have to pay your taxes, right? You have to pay them now. You don't have any inventory to sort of shelter it in. Okay, so that's the idea. So I think it's good to understand why you're going through all this in the first place. Why do we do this? Now, that's FIFO and LIFO. Average is sort of halfway in between. And what we do in our financial statements, we say, well, we're using average which approximates FIFO, or we're using an average which approximates LIFO. They don't really quite approximate, but they were easier to use when we're using periodic. On perpetual, it doesn't make any difference. The companies use all these methods, so we'll take a look at it. Okay? So let's try a little bit on this problem. Okay? Let's get started on the problem, see how this thing works. Maybe it'll make it clearer as we go. All right. So, what I suggest to you is that you do this. I would keep track of units of inventory and dollars of inventory, both. Okay? So in this particular problem, how many units do we start with there? Beginning inventory. How many units do we start with there? 16. What do we pay for?
$9.
What's 16 times 9?
144.
You guys want to calculate that? He was in the other class, it's cheating, he has a memory. Okay, so 16 times 9, right? 144.
Even last class, I could calculate something right.
Well, I think I calculated that one, but probably not 16 less 12 or something. Probably that ahead. Okay, 16 times 9 is 144, right guys? Okay, so if you were going to do a cost of goods sold schedule, what would you have for beginning inventory? Now, I wouldn't really write the units on there, but you might want to, you don't have to do both of these, you do one or the other, do both if you like, but let's do units and dollars both, okay? I started with 16 units that cost me $144. You guys with me? So I can do a cost of goods sold schedule, right? Beginning inventory plus purchases. Okay, now, for perpetual, you have to keep track of the order of things, right? The order that you bought and sold. Because with perpetual, you keep track of what you have all the time. So if you're selling something, you can't sell something you haven't bought yet. With periodic, you pretend you buy everything before you sell anything because you don't keep track of how much you have of everything. Make sense? You don't keep track of your inventory on an ongoing basis. So you just add up all your purchases, right? And then you pretend you sold, well, FIFO, the old ones, FIFO, the new ones, right? Weighted average and average one. Okay, that's what's going to happen. All right, so we got to keep them in order. And I can do a sale first or a purchase first, doesn't matter. This is really a simplistic example because there's only 2 sales and 2 purchases. How many sales do you think there are at Walmart a year? Never mind, it's millions, right? Millions and millions. Okay, but it's the same concept. Okay? How many purchases are there at a typical company? Hundreds, maybe thousands. Got the idea? For each inventory item. Or maybe just a few a year, right? Depending on what it is, what the company is, and what the item is. Okay, anyway. So what's the first thing that happens? Sale 1, right, is how many units? 12. Do I know what those units cost? No. I do know that I sold 12, but I do not know the cost. And what I want, this is the beginning inventory, I want to know the cost of goods sold. That's why we do this. The whole thing we're doing with all 6 of these methods, okay? I want to know the cost of goods sold, and I want to know the ending inventory. Cost of goods sold for my income statement, ending inventory for my balance sheet. Got it?
What's it say for the 12 units?
Sale 1. I used S1 instead of the date. Sale 1. Okay? I'm just keeping them in order. Okay? All right. So then what do I have? I don't know what those cost. Then what do I have? The first purchase. Okay? So January 15th. How many did I buy? 18 units. Do I know what those cost? Of course I know what those cost. They're $10. What's 18 times 10? So I know what my purchases are. If I'm using periodic, it's in the purchases account. If I'm using professional, it's in the inventory account. Got the idea? Okay, good. All right. So how much is that? 180? Good. Then what happens? Sale 2, I guess. Sale 1. Sale 2 comes next. I'd like to know the cost of goods sold on that guy. How many units for sale 2? 19. Okay. Reduce my inventory down by 19 units. Do I know what those cost? No. That's what I'm computing. Okay, then what happens? Second purchase, and I could have more of them. You know, maybe we can keep going. All right, what do we got? 17 units, what they cost? $11. How much is that? Excellent. Purchase 2. Okay, are we there? So, let's do purchases. How many units did we purchase? So I would add purchases here, right? How many did I purchase? 18 plus 17 in my little example, huh? 35? Of course, in real life, lots of them. Okay. How much did they cost me? 180 plus 187. What's that? Yeah. See you later. Okay. So now what do I know? I know what's available, don't I? How much? 16 and 35. 16 plus 18 plus 17, right? It's 51, is that right? 51 units available. What did they cost me? $144 plus 367, right? 144 plus 180 plus 187, right? How much is that? 511, isn't it? Okay. Good. This is easy, isn't it? That's going to be the same no matter which method I'm using. Now, in real life, because the ending inventory is different under the 6 methods, well, actually, there are 5 ones. 5 is going to be the same either method. But because ending inventory is different, guess what? Beginning of the next year is ending of the current year, right? Got that idea? In every single account in the general ledger, your ending balance 1 year is the beginning to the next year. But, right, millisecond later. Okay? Everybody got that, has that idea, right? We talked about it with closing the books, right? Nothing changes. Okay, between years. There's no time between years. So if you had different ending inventory, guess what? Next year's beginning would be different under these different methods. If we did it in a later year, and a later year, and a later year. I won't do that to you for the purposes of our problems. I'll make it all the same at the beginning. Okay? Just keep it simple. But in real life, it can be more complex. Okay, now here's what I want to do. I want to decide how much of that $511 goes in cost of goods sold and how much goes in ending inventory. If I subtract my ending inventory, right, I will get what? Cost of goods sold. Well, you know what? I can't do the dollars yet. Each one of them is going to be different with the different methods. But what can I do? I can do units. How many units did I sell? 12 plus 19, 31. Know what that is? How many do you have left? Whoops, did it backwards. I sold 31, right? How many do I have left? 20. It's okay, the other class couldn't do that either. I don't know why. It's right. Okay, anyway. So yeah, I have 51 available. There are 20 left, so 31 were sold. By the way, over here, can you tell how many are left? Can you? 16 less 12 is 4, plus 18 is 22, less 19 is 3, plus 17 is how many, you guys? 20 units. And what I want to do is value those, right? And I want that, so I want the value of this ending inventory, right? And I want the value of this cost of goods sold here, right, guys? So you can either do these T accounts, or you can do the cost of goods sold schedule, or both, I don't care, right? Doesn't make any difference. But I want this number, and that's all we're doing, okay? With the different methods. So let's give this a shot. Let's start with periodic, which means I go out and count them periodically, right? And let's start with FIFO. First in, first out. What do you think? Which ones, how many do I have first? How many units do I have in any inventory? For any of the methods, how many units are left? 20. It's 20, it's 20, it's 20, right? So it's 20 units. So for 20 units, which units? First in, first out. I assume I buy everything before I sell anything. Which ones do I have left? The last ones I bought. So which ones are those? What's my most recent purchase? 17 units. What they cost me? $11. How much is that? Calculate it. 27. How many more units do I need to make 20? 3 more units. Which ones? The next most recent purchase. In our case, purchase 1, but imagine there's 100 purchases in between, right? Take the next most recent. Got it? Okay. So, what do those cost? 10 bucks. Yeah, we're good, guys. How much? 30. What is my ending inventory here? 270. Just like that. I know ending inventory. Okay? Now I want you to calculate cost of goods sold. Look how easy this is. If you know the ending inventory is 217 for those 20 units, just plug 217 in. Right? Or over here on the T account, it's 217 in total, right? Everybody got it? Because those 2 sales are 217 in total with this method. Or 100 if you have 100 of them, 1,000 if you have 1,000. Okay, what's 511 less 217? Guess what my cost of goods sold is? Yeah, I bought 140. I started with 144. I bought 367. I had 511 available. I still have 217 left at the end. What don't I have? 294. That would include the theft and the damage when it's thrown away with, right? Everybody got the idea? Can't tell them apart with this method. 294. Okay. So we got 2, right? Inventory and cost of goods sold. Let's do periodic. LIFO. LIFO. Okay, periodic LIFO we're going to do. All right? How's that going to work? How many units do we have? 20 units, you guys. It just is, right? Don't change that. Before. Okay, what do you want to do? Which units? Last in, first out. Which ones do we keep? The beginning ones. Yeah, so there's 16 there. And then the first purchase and the purchase after that, right, guys? The oldest ones you get. So it's 16 at $9. Okay, and notice I do have inflation here. It went from 9 to 10 to 11. Right? So there's inflation. Okay, and then what? How many more? 4 units. Oh, by the way, what was 16 times 9? 144, right, guys? Staying with me? Okay. How many more we need for which purchase? The next most recent one, so we go down to purchase 1, right? Okay. Ideally, I'd give you more, but it makes it possible to pay you to do a quiz. See why I don't. Okay. But yeah, you go to the most recent purchase, right? I'm sorry, it's the oldest purchase, right? First the beginning inventory, then the first purchase, then the second purchase. Got the idea, everybody? Easy. So 4 units at what? $10. How much is that? 40? Everybody good with that? So what's my ending inventory? That's 184, isn't it? Let's calculate cost of goods sold. How would you do it? Yes, 511 less 184. That's all there is. Yeah. I'm just changing my ending inventory. Is it true that everything that's cost of goods sold plus everything that's in inventory equals my available? Right? You got to add it up. So it's 511 less 184. Okay. Can you do that for me? A quiz or test, of course. And use practice to listen to it. Now here, what's the difference between my cost of goods sold between these 2 methods? What if I use LIFO? Let's say I'm in a 40% tax bracket. Let's say these are millions of dollars. So my inventory is going to be either 217 million or 184. You got the idea? What is my cost of goods sold? Goes up by whatever the inventory goes down by, right? So I have 327 cost of goods sold instead of 294. What's the difference between those two numbers? 27 plus 6, what's that, 33 million? Let's say that we're in a 40% tax bracket, which lots of companies are. Right? They pay their taxes. Right? They're in about a 40% tax bracket, 34 to 35% for federal taxes, and then more for state. You have state income tax, right? So 40% is fairly common, right? You're in a state without, only do business in a state without state income tax is going to be more like 34 to 35%, just for the federal. Okay? Now, they don't pay that on all their revenues, right, guys? They pay that on their net income. Okay? So anyway, the 33,000 I said? I'd have 33,000 less income if I use LIFO than if I use FIFO. 33 million. What's 33 million times 40%? So much taxes, I'd say. What is that number? So I'm going to do that. 33 million times 0.4. How much taxes do they put off till later? Interest-free borrowing from the federal government for as long as you can keep it going, right? How much is that?
13.2 million.
Yeah, 13.2 million. Take it times every company in the U.S. Got it? That's how big this is. And it's year after year after year, it just keeps growing and growing and growing, right? Okay, got the idea? For any change in your inventory. If your inventory goes down, you have to pay the tax. If your inventory goes up, state taxes. Make sense? What happens if you get rid of that inventory item? It's no longer popular. You know, if you get rid of it, deplete it, sell it all off, sell it for low prices. You're going to have a big tax bill, right? Because your cost would be almost nothing if you held it very long. Got the idea? If you held it long, if you've been using it for a long time. Okay, so there's two of them. Okay, let's do weighted average. Okay, this one's weighted because we add up how many we have, right, available. This is still periodic. We add up how many we have, right? Well, how many is that? 51. We add up how much they cost us. How much is that? 511. Be sure and include the beginning inventory, right? And then we take the weighted average of it. What would we do? Divided by 51. You got it. That's it. It's just what's available, right? That's available. Everybody agree with that? Don't just use purchases. Okay? What's that per unit? $10.01. Kind of screwed this problem up a little because it's close to being the average of 9, 10, and 11, but it is not, right, guys? Because what if I bought $100 at $10, right? And I bought $100 at $11, and I started with 16 at $9. The average would be closer to something between 10 and 11, right? Be higher than 10. So that's just because I made these two numbers kind of close together that it came up real close. So you have to actually compute it. So 1001, right? Don't just take the average of the purchases. So 1001, what would my ending inventory? How many units do I have in inventory? 20? What's 20 units at 1001? What's my ending inventory? $200.20. Everybody agree with that? Make it millions if you want. 200 million, 200,000, right? Got the idea? What would be my cost of goods sold? Two ways you can go. What you could do is you could take the 1011 times what? 1001 times what? How would you sell? 31. What's 31 units times 1001? That's my cost of goods sold, isn't it? How much is that? 310.80. Okay. That's it. You get close. Okay. All right. What do those two add up to, of course? 511. So the other way you could do it, of course, is you could plug right in here. You could say, all right, my ending inventory this time is $200.20. Notice that ending inventory is sort of in between these two. It's the weighted average, right, method. So it's in between. And then what's 220 less 511? 310.80. Got it? That's Is this easy? Yes. Now here's some good news for you, and I'll let you out of here. It's the point I got with the other class too. Here's the good news. Periodic FIFO and perpetual FIFO are exactly the same. And the reason is you're always selling the oldest ones, so you're always keeping the new ones, right? With either method, it's going to be the same. So periodic and perpetual are the same number. The reason that's really good news is calculating perpetual is a real pain. You have to keep track of each layer. With FIFO, you don't have to worry about it, right? It's the same calculation. So what I would do if I were you, strongly suggest this quiz test and final, is calculate it using this periodic method. And then if I ask for perpetual too, or if I only ask for perpetual, still calculate it that way and write the answers down. So if I ask for both, like we did on this quiz, the answer to periodic and perpetual both, FIFO, are $294 for cost of goods sold and $217 for ending inventory. You got it? That's helpful, isn't it? It's going to be different for LIFO and moving average. And the reason is with perpetual, you will know when you bought something, so if you already have it, you can sell it then, right? Versus if it's periodic, you pretend you buy everything and then you sell off all the old stuff. Making, yeah, okay? You got it, guys? You can't sell it unless you have it for perpetual, right? Okay. All right, everybody? See what's going on? Easy? Have a good study break this weekend. I'm going to goof off. Now I have to grade exams for intermediate. Oh, 3 hours, page after page. You guys, though, you're working this weekend, right? Working. When do you get your break? 3 months to Christmas. Yay! You're gonna have the best Christmas you ever had. You're gonna get away from me. Just think about that. Then you get a whole semester away from me, and maybe show up in 211 and suffer again. See you guys. Keep working. Hang in.